There's lots of investment products out there. And today on the show, we're specifically looking at unit trusts and ETFs because that's what you guys have been asking me about. So today we're going to show you the comparisons of these two investment products.
Welcome to the Wealth Nation podcast, a podcast for every mother, daughter, grandmother, sister, and wife, and the men who are smart enough to tune in. The Wealth Nation podcast brings you all you need to know about investments, business, property investments, personal finance, and all-around financial wellness. Here is your host, Yolanda Rose.
Welcome to the Wealth Nation podcast. I am Yolanda, financial advisor and wealth coach, and it is my goal on this podcast every week to bring you easy, actionable tips, content, and strategies that you can use to manage your money well and to build generational wealth. And one of the ways that I am aiming to do that is with the 5 investments every South African needs masterclass that is happening on the 28th of October. So if you want to get into that masterclass, there's just a few spots left. I'm only hosting one for this year. So go to the website. It's www.financiallyfabulous.com/investor masterclass. Also, don't forget to reach out to us on Facebook. We're on all of the various platforms, LinkedIn, TikTok, Instagram, and Facebook. Our handle is Financially Fabulous Females. The Wealth Nation podcast is sponsored by Audible. Audible is a seller and producer of spoken audio entertainment, information, and educational programming on the internet. Audible sells digital audiobooks, radio and TV programs, and audio versions of magazines and newspapers. For a 30-day free trial of Audible, go to www.financiallyfabulousfemales.com/audible. So as you know, on the show, every week we look at various financial terminology, and we're not going to do that this week. I want to talk a bit about the president's address last week on the economic recovery plan, the recovery plan from lockdown and COVID-19. Now, some bold statements were made, all of which we heard before, from infrastructure development and foreign investment, more jobs, but nothing ever materializes. So if you were watching that address by the president, I'm sure you are as disheartened as I was, because there's nothing tangible in there. There was a lot of what's, but there were no hows, how they were going to get things done. How is 100 billion rand worth of stimulus going to come into the country with a shrinking tax population and foreign investment just drying up at the moment? So South Africa is in for a rude awakening. In preparation for that, I hope that you guys are investing well, reducing your debt, and looking at multiple incomes, because we are in for a rough ride as a country if you're not prepared. If you're listening to the show, this is one of the things that you should be doing to be prepared, is to bulk up on your financial knowledge, know what's out there, and prepare yourselves, because the storm is going to hit, and I want you guys to be prepared. The warning shots have been fired. All right, so at this point, we should all be ducking and getting up our armor.
Raising financially savvy children involves teaching them a variety of skills, from budgeting to planning to earning and saving. Besides giving them an understanding of the value of a rand, it prepares them for real-world finances. Financial literacy is a vital skill, and it is never too early to teach your kids about money. Many parents wonder how they can teach their kids about money and where to find age-appropriate resources. You can now purchase the Financial Literacy for Kids workbook, which is aimed at primary school kids. It's now available at www.financiallyfabulousfemales.com. This workbook provides you with 12 lessons, activities, lesson plans, discussion points, and quizzes that you can use to test your kids' knowledge. Shop now at www.financiallyfabulousfemales.com.
Like what you hear so far? Make sure you never miss a show by subscribing on Apple Podcasts, Spotify, or Tuned In. Now back to the show.
Well, so much investments and so little time. And today on the show, I hope to give you some insight into 2 of my favorite investments. Easy entry points, high liquidity, a nice long-term view. So I hope to give you some insight into unit trusts and ETFs today. And let's talk about the two. Well, if you haven't invested before, let's try and break this down for you. Both these investment instruments, unit trusts and ETFs, they're both collective investments. Collective meaning a bunch of investors, we all pool our money together. So we don't just all rally around. There is a properly managed financial services company, an investment company that allows us to pool investments and use that collective power as to leverage, to basically leverage and purchase assets and sell assets, and that spread, buy low, sell high, that spread gives us a profit. The major difference, I think, to bring understanding about unit trusts and ETFs is, in a unit trust, the asset management company, there's various funds. Now there's various asset management companies in South Africa, like Allan Gray, Coronation, Signia, Discovery has an asset manager, Liberty. Now, all of these big companies, Momentum, they all have their asset management units. So these asset managers create funds. For example, the ever popular Allan Gray Balanced Fund, Allan Gray Stable. Each of these funds have varying levels of risk. So if we look at Allan Gray Balanced, so that's a fund that has a mix of financial products within that fund. So right now I'm sitting with the Allan Gray Balanced Fund fact sheet in front of me. Now this size is 132 billion rand. That's how big this fund is. And there's about, 572 million units within the fund. And currently, the fund is priced, the unit is priced at around 100 Rand for one unit. So if you want to invest in this fund, you would go to your financial advisor. You could even go directly to Allan Gray. And now each advisor and each investment house, they all have their different parameters and entry points and minimum premiums and all of that. So you can go purchase a unit for 100 Rand of this. So maybe in 5 years' time, this unit will now be worth 150 Rand. So that difference, you bought it at 100 Rand, you sell it at 150 Rand, that 50 Rand is profit. Now, obviously, if you're doing it consistently, it's huge volumes of money that's actually involved. But that in a nutshell is how you make money with unit trust. But going back into this Allan Gray Balanced Fund, now you can purchase this fund on a unit trust platform. And let's try and see what's in here. All right. So the top 10 shareholdings of this company. Now, in any fund, from any asset manager, they don't tell you exactly what they're investing in because that's their secret recipe, right? But they try and give you an idea of how their investments are going by letting you know what the top 10 shareholdings of the actual fund is. So as of the 30th of September this year, 2020, their top holding was Naspers, then British American Tobacco, Glencore, Standard Bank, Woolworths, Remgro, First Rand, Old Mutual, Taiwan Semiconductor Manufacturing, and Sasol. And when we look at the asset classes, we see about 75% of that is an equity. That means 75% of this fund, of the 100 and something odd billion rand that's in this fund, 75% is in equity. They're holding shares in actual companies. And that's very typical of a balanced fund. They have about 70% equity in them. Then they're holding about 1% in property. Now, 1% of 100 and something odd billion, that's still a lot of money. Then they have about 4.3% into commodities, oil, gold, diamonds, that kind of thing. And they have about 13% in bonds, government debt. They're not telling us which government, local or offshore. And this specific fund can invest a maximum of 30% offshore. So they won't exactly tell us which 30% they have offshore in these asset classes. And the Allan Gray Balanced has about 6% in hard cash, in bank deposits and in the money market. So they're generating income through interest when it comes to the cash holdings. So that's the summary of the fund right there. So when it comes to the shares portion, that's 75%. This fund makes money by the dividends that they get as shareholders. Also, when they sell those shares as well, hopefully they're selling it at a profit and then they're making money that way. Property, they're holding property that can either be rentals or they're buying, selling property. Commodities, they're buying low and they're selling high. Government bonds, they're holding government debt. That means they're getting interest payments after a certain period, sometimes 10, 15, 20 years. They have a set interest rate on that. Actually, for those bonds, 10% are in South Africa, and 1.5% is in Africa, and 2.3% of those bonds are offshore bonds. All right, and then money markets and cash, it's interest. So that's how this fund makes money, in a nutshell. So you can buy Allen Gray Balanced on a unit trust platform. So unit trust, like we said, going back to the actual difference of a unit trust and EFT, it's a collective investment. Now, the thing about unit trust, we did say it was a mixed portfolio where they're holding cash, equity, shares, government bonds, and offshore, like we discussed in the whole breakdown of Allen Gray Balance. So when it comes to the portfolio mix of ETFs are only holding shares. So if you go to an ETF platform and you look, maybe they'll have a gold bundle. Yeah, so when it comes to my personal ETFs, I have a bunch, but I'm holding a bunch of ETFs, investing in a bunch of ETFs in the tax-free platform. So I don't have all of the tax liabilities. So when it comes to ETF, they're kind of themed, So you'll have like a world government bond ETF. So that ETF is holding shares in government bonds. Then you'll get like an S&P 500 ETF. So they're tracking it's basically a tracker ETF. They're tracking the S&P 500 and they try to mimic the performance of the S&P 500. And S&P over like a period of 50, 60 years, they average around a 10% return. So that's all they are. They're basically a collection of shares, and all of the various asset companies will track these shares and hold these basket of shares. The nice thing I like about ETFs is that they're almost immediate access. For example, if I sell any of my ETFs in the morning, in a couple of hours, I have full access to the money. Whereas with unit trusts basically there's a maybe 3 to 4 day waiting time, mainly because of the paperwork that has to be done. Unit trust, you got to buy via an advisor and fill in forms and things like that. Whereas ETFs, you can buy it on electronic platform. You do have the disadvantage of not really having a financial advisor guidance on that, getting your risk analysis done. So when you buy unit trust with a financial advisor, an advisor will help you in that way. Whereas ETFs, yes, an advisor can help you if he has access to ETFs on his Manco or on his investment platform. Otherwise, you can buy ETFs directly, and that's one of the really nice things. I have my ETFs. I have some that I buy on a unit trust platform because I am a financial advisor, and there are some that I buy from my cell phone. I'm directly with the stockbroker. So that's one of the biggest conveniences of ETFs. Another thing to understand about both these products is the tax liabilities. Both are basically the same when it comes to your tax liabilities. Like when you sell, you're liable for capital gains tax. There is the exemption of 40,000 Rand. But after that, capital gains for individuals is at around 40%, I think, the last time I checked. And then you are taxed at your marginal tax rate. There's also dividend withholding tax. That's on both these platforms, ETFs and unit trusts. Dividends withholding is around 20% now. And this is a little bit more convenient because whichever company that you're with, they will deduct that money from you and pay it directly to SARS on your behalf. So it's good because you don't really feel that pinch because they're handling it for you, but you don't really know how much is lost, how much you're actually using, so you're not feeling it that way. So there is a pros and cons of the dividend withholding tax. Yeah, so that's basically it, the difference between unit trusts and ETFs. It's the ease of access, it's the liquidity, it's the actual investment, those portfolios, what those underlying assets are. With unit trust, it can be a mix. It's a lot more diversified, whereas ETFs is only hitting that equity segment. And unit trust, you can go into cash, bonds, offshore, whereas ETFs, you're basically limited to those trackers or something themes like only government bonds or only one sort of thing. Liquidity is the biggest. This is the biggest thing here as well. ETFs is almost immediate or maximum overnight, whereas with unit trusts, it's a 4 to 5 day. Some cases, if you're lucky, 3 days, and you can get your funds out of that unit trust. So yeah, those are the differences. And remember, don't forget to sign up for our investor masterclass. We're going to be talking about these investments as well in far more detail, where I can show you examples on that masterclass as it will be in video. So you get to see some nice examples, and I'll show you inside my portfolio as well. ETFs is just definitely one of the things that most South Africans need to be having in their portfolios, and we're going to talk about that a lot more on the 28th of October. So that's it for me on this episode of the Wealth Nation podcast. I'll talk to you next week.
Thanks for tuning in. Make sure to visit our website at www.financiallyfabulousfemales.com and sign up for our free investment masterclass.